Do you know how your salary is taxed under the Income Tax Act 1961? This act, an integral part of India's financial framework, outlines various heads of income, one of which is income from salaries. This head encompasses the rules and regulations for the taxation of salaries, ensuring a fair and balanced taxation system. Understanding these rules can help you better manage your finances and make informed financial decisions. So, buckle up. In this video, we delve into the specifics of income under the head salaries. So what exactly is income under the head salaries? Well, as the term suggests, it's the income that an individual earns as a result of employment. This income can come from a variety of sources, but the most common is a paycheck from an employer. But it's not as simple as just the amount that hits your bank account at the end of the month. Oh no, there's much more to it than that. Income under the head salaries is a comprehensive term that encompasses various components. Let's delve a bit deeper and break this down. Firstly, we have the basic salary. This is the core of your income, the fixed component that you receive regardless of performance metrics or external factors. It forms the largest chunk of your salary and is fully taxable under the Income Tax Act of 1961. Next up, we have allowances. These are the amounts given to an employee to meet certain types of expenses. They could be house rent allowance, dearness allowance, or travel allowance, just to name a few. While some allowances are entirely taxable, others may be partially taxable or even fully exempt from tax. Moving on to perquisites, also known as perks or fringe benefits. These are the non-cash benefits that an employer provides to an employee. This could include things like a company car, subsidized meals, or accommodation. Perquisites are generally taxable, but the amount of tax depends on their nature and the rules laid out in the Income Tax Act. Lastly, we have profit in lieu of salary. This includes any payment received by an employee from an employer or a former employer that is not part of the regular salary. It could be in the form of a bonus, a commission, or even a golden handshake. So there you have it, a quick rundown of the various components that make up income under the head salaries. Now that we know the components, let's explore each one. First up, the basic salary. This is the fixed component in your pay structure, and typically it forms the largest chunk of your earnings. It's the part of your income that doesn't change regardless of performance or company profits. It's your guaranteed pay, the minimum you can expect to earn. Now here's the critical part. Your basic salary is fully taxable according to your respective income tax slab. That means if your income tax slab is 10%, then 10% of your basic salary goes to taxes. If it's 20%, then 20% goes to taxes. The higher your tax slab, the larger the portion of your basic salary that gets taxed. So in essence, the basic salary is the most significant part of your income, but it's also the part that is most heavily taxed. It's the bread and butter of your earnings, but remember, it's also the bread and butter of your tax liability. Basic salary is straightforward, but what about allowances? Next, we have allowances. Allowances are a significant part of your salary structure, and they cover various aspects of your professional and personal expenses. Now, these allowances can be categorized into three broad types based on their taxation status: fully taxable, partly taxable, and exempted from tax. First up, let's talk about fully taxable allowances. These are the allowances which are fully added to your income and taxed accordingly. Examples of such allowances include city compensatory allowance and special allowance. Essentially, these allowances are considered as your income and you have to pay tax on the full amount. On the other hand, we have partly taxable allowances. As the name suggests, a portion of these allowances is exempted from tax, while the rest is taxable. The most common example of this type is the house rent allowance, or HRA. The tax-exempt part of HRA is calculated based on certain conditions, and the rest is added to your income for taxation. Then there are allowances that are completely exempted from tax. These allowances are not added to your income, and therefore, you don't have to pay any tax on them. Allowances like the transport allowance for a physically disabled employee fall under this category. Next, we have the dearness allowance or DA. This allowance is given to employees to mitigate the impact of inflation. DA is fully taxable for all employees, irrespective of whether they are government or non-government employees. It's important to remember that every allowance has its own set of rules for taxation. The tax treatment of each allowance is defined under the Income Tax Act of 1961, and it's essential to understand these rules to correctly calculate your tax liability. Allowances can be a bit complex, but with understanding, they become clear. Now, on to perquisites. Understanding how allowances work and their tax implications can help you plan your taxes better and potentially save a significant amount of money. So take your time to understand them, consult with a tax professional if you need to, and make informed decisions about your salary structure. What are perquisites, you ask? Well, let's delve into this fascinating aspect of income under the head salaries. Perquisites, often referred to as perks, are the additional benefits that an employee enjoys over and above their basic salary. They are not part of your wage, but are provided by the employer for the convenience or benefit of the employee. Now you might be wondering, what kinds of benefits are we talking about? Well, these could range from a company car, or a furnished accommodation to education facilities for your children, or even free meals at the office cafeteria. Essentially, if it's a benefit provided by your employer that goes beyond your basic salary, it's a perquisite. Perquisites can significantly enhance your overall remuneration package. However, it's important to note that not all perquisites are treated the same way when it comes to taxation. Some are tax-free, while others are taxable, depending on their nature. Tax-free perquisites include benefits that are not monetary, like the use of a gym or a recreational facility provided by the employer. On the other hand, taxable perquisites include benefits like a company-provided car for personal use or rent-free accommodation. These are considered part of your taxable income and therefore are subject to tax. The value of these taxable perquisites is determined based on rules specified under the Income Tax Act. For example, the value of a company-provided car would be calculated based on factors like the initial cost of the car, its engine capacity, and whether it's used solely for business or also for personal purposes. Understanding the tax implications of your perquisites is crucial to avoid any surprises at the end of the financial year. It's always a good idea to consult with a tax professional or use a reliable tax calculator to estimate your tax liability accurately. Perquisites can add a nice bonus to your salary, but remember, they may be taxable. Lastly, we have profit in lieu of salary. Finally, we reach profit in lieu of salary. This term might sound complex, but it's actually quite straightforward. This refers to the payment received by an employee in lieu of or in addition to their regular salary. It's a common practice in various industries, particularly in situations where an employee might be leaving a company or there might be an agreement for a different form of compensation. Profit in lieu of salary can take various forms. It could be a golden handshake, compensation due to the modification of the terms of employment, or even amounts received before joining an employment. Now, here's the kicker. Profit in lieu of salary is generally fully taxable. That's right, in most cases, you won't be able to escape the taxman's grasp on this one. And with that, we've covered all the components of income under the head salaries. Stay tuned for the next segment where we'll summarize all the key points we've discussed so far. Let's summarize what we've learned today. We started by discussing the concept of income under the head salaries under the Income Tax Act of 1961. We learned that this income category includes not just your basic salary, but a host of other components as well. We dived into the basic salary, which is the core of your income and the base for calculating other components. It's fully taxable, and the more you understand it, the better you can plan your tax payments. We then moved on to allowances, the fixed amounts paid to you over and above your basic salary. These can be fully taxable, partially taxable, or completely exempt depending on their nature. Next, we explored the world of perquisites, or perks. These are non-cash benefits provided by employers, and their taxability can vary. Some are fully taxable, while others come with certain exemptions. We also touched on the concept of profit in lieu of salary. This includes any payment received in lieu of or in addition to salary. It's typically taxable, but certain exceptions do exist. Remember, understanding your salary structure can help you manage your taxes better. So stay informed, stay tax savvy,